Thank you so much, and I should probably update that because the most recent time would have only been just a couple of months ago when the market fell apart, but we'll talk about that a bit later. And thank you everyone at the Trading Pub for having me on tonight. It's great to kind of be talking about this topic. It's a topic we revisit once every year, which is talking about the smart money and how it is incorporated into finding trades, because it's my belief that the smart money is probably one of the most important parts to every single trade that I do is looking at where the smart money is going, and it underpins ultimately a lot of, almost all of the other types of techniques I've used in the past come back to some detecting some part of that process. Of course, the standard disclaimers up on the screen there, because we will be talking about live stocks, and I'll invite anyone here in the audience to ask some questions about different stocks you may be interested in towards the end. Of course, it's not a recommendation to buy or sell any of those securities. Okay, so yes, as I said, very basic introduction. We were founded back in 2007, and up until that point, I did follow the fundamentals quite a fair bit in terms of looking at the stories of different companies. But as I'm sure everyone in the room has recognized, the value of those fundamentals in terms of timing and investment is very difficult, because you can buy the right company at the wrong time, or you could also buy the wrong company at the right time and make money. So having an understanding of the technicals, of course, was a very big important part for us. And especially when we start to look at, where we're at in the world, again, going into this new year, central banks are still pumping huge amounts of money into the economy, and we've seen what's been going on with Japan. Massive amounts of Abenomics going on. We've got obviously the key questions as the worldwide markets suffer, but the American markets, North American markets, still do really well. Is this based on true economic activity, or are we simply diverging away from the mean to scary heights? And of course, anyone who's followed the rules of divergence before would know it's a wonderful way to find short opportunities. So when we see the US economy and markets diverging away, are we leading into another similar type of problem? So these are the kind of questions that we start to see. Of course, we've got optimism amongst market players, IPOs launching, the tech sector and healthcare sector on a storm. Typically, all of these are signs of potentially topping markets. And if we look at where the market leaders have been, it's been a lot of the cloud computing, technology. So again, the questions we want to start to ask ourselves are not necessarily, is the sky falling? I don't think that as traders that we're trying to really look out to see where the economy is going to be in 6 months from now. In my opinion, as a trader, I'm not too interested in looking at, making an opinion on what I think. As a trader, it's more simply to make sure that we have a quantifiable way of protecting against the market if it was to correct, and also a quantifiable way of taking advantage of the market if it indeed continues to rally. But having a plan is the key factor here. So when you start to look at what type of trading you may do, obviously the how far out we want to look and what type of strategies we put in place is obviously, it will fall into one of these three categories. We're either going to be looking at very short term on a day trading scale all the way up to long term. But no matter what type of time frame we're trading or investing in, the key thing that is constant is the role of smart money within each of these parameters. So skip forward here. So the key question I wanted to kind of pose to people here is, how do most people make their decisions at the moment? How do you determine what stock you're going to buy tomorrow? And most people are using methodologies that are, maybe story-based, newsletters, tips from friends, financial brokers, things that they're familiar with. These are the common things that I hear where people get their trading ideas from. Maybe it's the TV, listening to talking heads. And none of these are inherently wrong on their own, then none of them are inherently invalid, but it's when we rely on these areas as our sole source where it becomes an issue. Because when we get a great investment idea, this company XYZ is going to be the next best thing since sliced bread, how do we take that idea and put it through I'll use that word again, how do we determine the risk-reward ratio to ensure that we're setting realistic targets as well as realistic stop losses versus just trying to impose our will on the chart? So these are the kind of things that we need to start determining. If we're going to have consistent profits, there has to be a consistent methodology that we use to run these ideas through. And without that, that's of course why you see those same problems of where people make all these emotional errors, where they believe so much in the story, but they don't know how to time the investment. So when the stock drops, they simply just keep buying more and averaging down. And in my opinion, averaging down, it might hold some weight in investment strategies, but if you have the skill set to time your technical analysis properly, you would never average down, because you would sell when it broke support and buy it back at support versus just continuing to put more in as it drops. So a lot of the time we fall into these traps of failing to limit losses and averaging down and so forth because we don't understand the very clearly defined rules that are placed on the chart that the smart money uses, but often the retail trader does not as much as they should. And that's why I think most people lose money, is that they're constantly reacting to the market emotionally. And of course, that's exactly what the stock market wants you to do. So if you think about it, what is the stock market? It's a business. And if you subscribe to the idea that the smart money essentially are making the majority of the money, the 1%, or statistically a brokerage study was done that showed 85% of traders lost money, only 15% of traders made money. You want to subscribe to the idea of the fact that the world's top billionaires make up more than 80% of the world's wealth. I mean, that's the reason is because it's a very, very well-run business. And the idea of the stock market, of course, is that for Goldman Sachs to make $1 billion on a trade by selling at the absolute top of the chart, what does that require? It means there needs to be $1 billion worth of buying from people who are wrong, from people who will lose money. So it's a negative sum game. For the smart money to continue making money, people have to be wrong. And so it's in the market's interest to keep people confused, keep people buying at the worst time and selling at the best time. Whereas the smart money is either getting out or essentially moving against you. So now we start getting into kind of more of the technical side of things, and you start to ask yourself, well, how do you exactly identify this in a chart? And if you were to sit down right now and take a pen and paper and you were to draw exactly what the chart would look like when you're looking to purchase it, what would that look? What would that look like? What would the candlesticks be doing? Would it be an engulfing candle? Are you looking for an oscillating trade, or are you looking for a momentum trade, or are you looking for a breakout trade? You know, what is the pattern doing? What's the volume doing? If you look at fundamentals, what would the P to E ratio range be? The price to book, you know, you get my point. And it's very important that you have this funnel, this idea of what meets a good investment to be. And then once you have that chart in mind, then and only then is it time now that we apply our indicators to confirm the trade. So if we want to have consistency, this process needs to be in place. So I'm going to start going through now and exploring, you know, how we determine some of these things. So I always like to approach everything I do with my trading from with an engineering mindset. So when looking at charts, I'm always trying to reverse engineer the process of what we're ultimately trying to look for. So when looking at the stock market, we ask a very basic question. If we're trying to find a stock that's going to go up, we need to understand what causes the stock to go up. It causes its volume. It's buying a higher supply of buyers versus there are in sellers. So a very basic statement we can answer there is who controls the market? Well, volume controls the market. Now, 20 years ago, where did volume come from? Well, 20, 30 years ago, volume came from a decision process that was driven by people reading the news, watching TV, reading the newspaper, the radio, getting a phone call with a stockbroker. One of those people that hardly even exists these days. So 30 years ago, volume came from research. Volume came from updated news daily. And that's why the baby boomers and the fundamentals was so important 30 years ago, because that's where volume came from. These days, it's the opposite. Now, I remember when we started Acorn in 2007, and I would talk to people about technical analysis, and most people thought I was nuts. They thought it was voodoo. And then, of course, when the market crashed and this huge amounts of volatility started to become very apparent, now all of a sudden people have started to pay much more attention, because ultimately what's changed in the last 10 years is that now an estimated 80% of all of the trades that happen in the market come from algorithms, which are driven, of course, by technicals. They're driven by rules of when to buy and sell, and of course where to buy and sell. And these are very organized. This is a very organized chaos. And you think about the flash crash of May 2010, market plunges 1,000 points and then goes straight back up again. You know, a month of movement in each direction within 15, 20 minutes. So the idea about smart money, though, is it's easy to say, well, gee, you know, the retail trader then doesn't really have much chance. And yes, I'd agree that most people in the market probably shouldn't be there because they aren't educated and they just end up losing money. But if we can understand that the smart money is accounting for a huge percentage of the volume. And by the way, that doesn't mean they have 80% of the money. What it means, though, is if you have, say, if you bought a stock with 100 grand today and held it, and then somebody else comes along with $1,000 and buys the same stock, well, you would account for 100,000 in volume, and that other person would account for 1,000 in volume. But what if that other person then sold it? Well, now they would account for 2,000. And what if they did that 100 times that day? Well, now they would account for 200,000 in volume. So you can see my point. With 1% of your capital, that person has 200% of the footprint. They account for 200% more volume than you do with only 1% of your capital. And that's how high frequency trading can have such an incredible impact on the market. But the beauty of this is that whenever something is programmed, whenever something is doing the same thing over and over and over again with certain patterns, it can be reverse engineered. It can be you can suss it out, so to speak. Now, the way they try and keep people on their toes, the way they keep it being confusing, is they have so many of these algorithms. They have over 60 commonly recognized patterns that operate within the stock market, plus many more. So the key to being able to trade profitably is, or to a high degree, is to be able to anticipate when these patterns are coming into effect. Not by recognizing them when they've already happened, because that's often too late, but how do we recognize these patterns as they begin? So the first thing that we need to do if we're going to be able to work through a chart with a high degree of profitability is to be able to recognize that be able to recognize the guidelines of how a stock moves. And it's my belief that a stock will never change direction, or an index, unless it's hit one of the following three things: horizontal support, trend line resistance, or moving averages. So when we look at a chart, our very first job is to actually look at the chart and then determine which of these three things are being hit. So we'll look at whether it's a horizontal level, we'll look at whether it's a trend line or diagonal level, or we'll look at whether it's a moving average type of level. And depending on which of these three things are in control, it will then tell us the personality of the stock, whether it's momentum, oscillation, or breakout. And so based on those three things, we can then start to drill down further and say, okay, if it's momentum or a breakout, what type of pattern is it in? Is it a cup and handle? Is it an ascending triangle? Is it a flag? But we're able to drill down and see what type of personality and therefore what type of pattern we're dealing with, and then that will tell us how to trade it. So in other words, when you're looking at a chart, we don't want to be recognizing or spending so much time on this as much as we do looking at the levels, because these levels, whether they're horizontal or diagonal or moving averages, represent the points where the smart money, the big money, makes its decisions to buy or sell. And those are our checkpoints where we want to be considering the same. So let's push forward to have a look here at how we figure out where these levels are. Now, basic support and resistance, I'm sure most people have had experience with. But ultimately, we want to be a little bit more advanced than that. We don't want to just look at where any support level is. What we want to do is we want to be finding the strong levels. So the characteristics of a strong level here is, firstly, we want to be identifying an area where the stock has rallied sharply. So again, come back to the reverse engineering standpoint. If we're looking at an oscillating stock, so a stock that basically bounces back and forth between levels very sharply, then we're looking to essentially buy at a point that we believe the smart money is going to load up at. So when we look at a chart and we're trying to determine where we want to buy, you want to be focusing on the strongest levels. See, most people fall into the trap of feeling like they have to trade. So people will, they'll look at they'll go into a trading room or something like that, pardon me, and they'll say, what would you do with Apple today? And I'm sure we're going to get some questions like that towards the end tonight. But they'll say, well, what would you do with Apple today? What would you do with Priceline today? What would you do with IBM today? And just that very line of questioning has some fault to it, because what's to say you'd do anything with it? And in my opinion, if you're going to be a highly profitable trader, what we should be asking ourselves is, where would the best place to be buying IBM at? Where would be the best place to short Priceline at? And wait for that trade to happen. And maybe it doesn't happen for 3 months, but wait for it to be ideal. And see, most people don't do that because they're only trading maybe 10 or 12 stocks that they're familiar with, because once again, how they find their investment ideas is by investing in things that they're familiar with. So what I'm proposing is that when you look at a chart, the most important thing to do is to figure out, where are we even interested in taking a trade, if at all. So if I was given this scenario, we would want to be asking ourselves, where would we want to trade this stock? What would we do with it? So a weaker trader, in my opinion, would say, oh, we'd buy it now because it's at support, at this second green line. We're at support, so we'll buy it now. Now, I would disagree with that. Where I would suggest the best trade on this would be is to wait for it to come back down to the bottom support line. The second best trade would be to wait for it to rally to the top resistance line. And the two trades in between, I would not even touch. And here's why. Firstly, when we're looking for strong resistance or support, we are by definition looking for a place that has represented a very heavy presence of that algorithmic buying. So we're trying to find that floor, like the flash crash, where the markets have just shot up. So in this chart, you can see that this bottom support line would be the place that was the strongest. In other words, when this hypothetical stock had hit the support, it went up 1, 2, 3 levels. Whereas at the top, you can see we only dropped 2 levels. So if we can compare one level to the other, the support at the bottom is more powerful. It was able to surge further than the selling was able to push it down. So it's the strongest level. The second thing we want to see is we want to see that it's sharp. We want to see that we go straight down to straight up. So we're wanting to see that immense power to send it shooting immediately up for support because of the nature of the type of buying that happens there. So we want to see it strong. We want to see a quick reversal. And the third thing we want to see is we want to see that it's fresh. So we can see here that in this example, this bottom support has only been tested once. The top has also only been tested once, whereas in the middle, we've now got 1, 2, this would now be the third test. And when you're looking at support and resistance, less is best. Whenever I teach this, there's often quite a lot of people who've been taught the opposite, that the more times support has been hit, the better. It's actually the reverse. And this is why, again, I mean, the market is there to fool us, because, or why most people fall into the emotional traps and lose money, is that in everyday life, if you went to see a horse race and you saw that a horse had won 4 of its previous races out of 4, then logically you'd assume that it's the one to bet on for the next one. But that same logic doesn't apply in the stock market. If we see that $10 has held the stock up once, twice, 3 times, 4 times, the logical side or emotional side of the brain wants to think, well, that must mean that that's really strong support. And that's exactly what the smart money wants you to think, because typically after 3 times that support's been tested, it will then break. And that's when the retail trader feels most confident in buying, and that's of course what creates a wonderful market for the smart money to sell to as it hits that support and breaks. So we want to see strong, we want to see quick, and we want to see fresh levels. So I use what's called the power of 3. If it's hit more than 3 times, I ignore it. And then, as I said, the other thing is also looking at the shape. So if we were given these 2 examples, A and B, and we were to consider which would be the highest profitable trade to short, it would be B. A has that rounded top. It's called an Eve and Adam double top. This on the right-hand side is called an Adam and Adam double top. And if you were to look at how much more effective one was versus the other, the ranking on B is 13 out of 50 in terms of effectiveness, and A ranks at 36 out of 50 in terms of effectiveness, which is a ratio of profitability and probability. So essentially, once we start to understand where these patterns are, and we're going to bring up some live charts here in a second. The next thing that we want to do is then start to understand the role that the smart money is playing here. Now, when we look at a chart, there's obviously a role that the fundamentals play. And so for those of you who like doing the research, you like reading the newsletters and watching the TV, great. But here's my thought on that. If you want to think about, if you want to do the research and look into the fundamentals and so forth, just understand that, or at least it's my opinion, that the guys over there at Goldman Sachs, JP Morgan, Knight Capital, you name it, I mean, these guys have got floors and floors of quantitative analysts, economists, people that do nothing all day long other than read through fundamentals and study economic cycles and so forth. So that's who you're competing with. That's who you're trying to outsmart. These are people that have specialist degrees in technology. people that have expert degrees in legal situations. That's the kind of caliber of teams that are doing nothing but this type of research. So competing with it, A, is very difficult. Secondly, they have much, much bigger resources. So if you want to look at some of the trading algorithms they use, for example, there's a program I was told about just recently that I think costs over $100,000 a month to subscribe to, or to lease. And what this program does is it analyzes worldwide events all over the place. So to the degree that it'll look at when hurricanes, for example, are coming on shore, and it will look at where that hurricane is expected to hit first, the degree of severity of the hurricane, and then what it'll do is it'll find insurance companies that have the most exposure in those areas and then start shorting those stocks. And all of this happens in split seconds before you're even aware of the news. So that's the kind of resources you're competing against. You're competing against companies that have satellite footage of mining exploration sites to see what companies are getting up to, and if there's a lot of activity going on in an area that hasn't been reported to the public yet. That's the kind of resources we're competing with. So when we start to now incorporate the smart money in terms of investing, this next part kind of operates on the understanding that, yes, there's a lot of value with fundamentals, but most fundamentals are already priced into the stock, especially if it's something that's commonly available news. And so what my focus is in the strategies is to use technicals to detect the buying practices of the smart money, with the understanding that I'm going to let them do the research for me. And if I see that they're loading up, I really don't care why they're loading up. I don't need to understand why they are, because the most important thing is that they are, especially where they represent such a high degree of the volume. And so we talked about the technical checklist for smart money in terms of the strong levels of buying, fresh levels, powerful levels. We can also combine this with an understanding of looking for correlating trades with the market, so looking for obviously bullish trades in bull markets, in bull sectors. So if we start to look at some examples of trades like this, CBOE is a good example. This is actually a stock you can see, the Chicago Board of Options Exchange, rallies up, hits smart money resistance, straight down. So you can see that type of move we're looking for, that straight up, straight down, straight up, straight down. Over here we get our third instance. Straight into that area, straight down. So we're looking for that sharp, aggressive drop. And once we've then identified these types of charts, then we can start going into the indicators to confirm it. So if we're looking for something that is rallying in an extreme way into resistance or falling in an extreme way into support, that's when we start using our indicators such as overbought and oversold. We start to look for volume patterns. Then we can use price action tools such as looking for the stock to have broken outside of its Bollinger Band. These are all the things that are now very effective in confirming a trade like this. And the second last thing we then do is we then look at the pattern. So, because this will then increase those odds even further. So are we rallying into that resistance within a rising wedge, which would be a strongly bearish pattern? Do we have the Adam and Adam double top versus the Adam and Eve double top? And this is where your then trading gets to the a real pinnacle of performance, is by recognizing then which patterns you want to trade. So out of those 60 different patterns, there is a handful that are extremely reliable and profitable. Head and shoulders, for example, is one of the highest ranking patterns if you can catch it early enough and identify it properly. So the key now is to not only identify the areas in a chart that you're interested in, confirm when the smart money supports your trade, but then also to make sure that the chart pattern is one that supports the direction of your trade as well to a high degree of probability. And then if we get all of this happening together, that's when we have a perfect storm. Okay, now I keep talking about the smart money and looking at what and detecting the smart money and knowing what they're doing, but how do we actually do that in a quantifiable way is what I want to talk about now. How do we actually detect it or see it on a chart? So I'm just going to switch over to my, oops. Going to switch over to the charting tool now. Okay. So how we do this can be through several methods. Obviously, one method of understanding the smart money is by looking at insider trading. Looking at whether the insiders are buying or selling. We can also look at whether the insiders whether the institutions are buying or selling. And these are going to be tools that will very, very quickly give us an idea of what's going on with the stock. Okay, so those are kind of, and you can do that through a lot of news sites. You can do that through FinViz. You can do that through Insider Cow. So that's one method of looking at what the smart money is doing. But another method is understanding the process of accumulation versus distribution. So if we look at the Dow theory, if we consider the Dow theory suggests that in all market rallies or all stock rallies, there are three zones. There's the accumulation zone, which is what Charles Dow suggests is where the smart money gets in. That's the first part of the trade. Then there is the public participation zone, which is the middle. And then there's the distribution, which is at the top. And this is when public excitement is at its highest. And this is when the smart money is offloading its position to the public at the top. And that's how the smart money makes its money. So how do we detect which zone we're in is a very valuable part of the process. So I'm going to bring up a couple of stocks here. Okay, so for most people in the room, what do you consider to be a uptrend? What's the definition of an uptrend? What's a technical definition? It's a higher highs and higher lows, right? Higher highs and higher lows. Now, but is that necessarily true? If you were to be given a chart that looked like this, That would be higher highs and higher lows. But this would not be an uptrend at all that I would want to buy. Likewise, if the stock was making, because this would be a rising wedge, which would be bearish. Likewise, if the stock was making higher highs and higher lows, but was closing lower and lower in the range, like that, that's also something I would definitely not want to be buying, because that's a sign of a reversal. Or if I was making higher highs and higher lows and volume was dropping out of the sky, again, I would also be very, very concerned about that trend and whether it would last any longer. And this is the difference. We need to start anticipating what's going to happen next, not just reacting to what's already on the chart. So higher highs and higher lows tells us what's already happened. What's going to happen next, it comes out through the volume, it comes out through the way the stock is closing and all these other factors. And that's, of course, where all these indicators come from. So think about all the indicators that you've been taught to use. Maybe you've been taught to use directional movement indicators. So you add your directional movement system and your ADX on there. Of course, what does a directional movement system tell you? Directional movement system tells you, is it making higher highs and higher lows, directional movement plus and negative. Okay, so you add that on your chart. Then you go and add your stochastic on. Okay, there's a stochastic, and all right, now we've got that on there. So what's the stochastic tell us? Well, it tells us, is the stock closing in the top half of the range or not? Or is it at the bottom? So where in the range is the stock closing? So we add our stochastic on there. Then maybe we go and add on our on-balance volume to tell us whether volume is increasing as the price goes up. We go and do that. Right, so basically, you've now, the more and more you do this, then you add on your RSI, your Bollinger Bands, you name it. You've basically now filled the screen with the indicators that are arguably indicator overload or clutter. And it's not that they're not valuable, but it's essentially all these things are doing are telling us different pieces of the puzzle to what indicates a real uptrend. So all these things on the screen now are really just trying to tell us whether there's a real uptrend or not. Is the stock making new highs and higher highs and higher lows? Is it closing in the top half of the range? And is volume increasing with it? Now, the beauty about, so whether people realize that or not, if all of those things are happening, what that means is that the smart money is buying and holding. They are accumulating. If it's higher highs and higher lows with higher volume and high closes, what that means is strong buyer commitment. And if the smart money represent 80% of the market, then those are the people, those are the powers that be that need to be buying and holding in order for that trend to occur. So, one way to simplify this is I use something called money flow. It's one of the indicators I use to indicate the presence of smart money. And what this does is it combines all of those things that I just mentioned, all of those indicators. It basically puts it into one to tell us if the presence of accumulation is occurring versus distribution. And so if we look at this, you can see it's ranked from below 0 or above 0. Below 0 is distribution, above 0 is accumulation. And so as we start to look at this, a stock like this, which is IBM, as this stock went towards earnings announcements, this was something that we picked as a short, as something to be buying $170 put options on, which went up well over 800% in just a few days. And here's how we predicted that, by combining all of the things I've talked to you about today so far. Firstly, and perhaps one of the big giveaways, was that IBM was in a head and shoulders pattern. Just a little bit crudely there. Yep, there we go. So that the two should be, there we go, the two should be perfect. So we see the left shoulder, we see the head, we see the right shoulder, and then we get a complex extended right shoulder. So this is called a bit of a mishmash between a head and shoulders and a complex head and shoulders because of the extended right shoulder. So first and foremost, our very first job when we look at the chart is to figure out what type of pattern it is in. And we figure that out by identifying what controls its movement. And from December all the way through to October, these two lines almost perfectly indicate every turning point that IBM had, except one, except the middle. And what we know about head and shoulders, of course, is that if we have a perfectly symmetrical left triangle and a perfectly symmetrical right triangle, there will be a break in the middle. And so this therefore allows us to consider this line still valid as it's part of the pattern. And this breakthrough is symbolic of a head and shoulders. So we now have a highly successful pattern. So what we can then do is we can measure from the head to the neckline and anticipate how much we expect that to drop, which was down to 165, which of course it did. So this now tells us we have a possible short. And where would we short that? We would short it, as most people would know, we sell resistance and buy support. So the possible places to get into this would have been up here at 195 when the right shoulder came up. And we would have known where this was by connecting these 2 points and extending that right line to the right, as well as matching the gradient. Even if we had been off and we hadn't drawn our line correctly, you can see we get a bottom and bottom here that also tells us the gradient, and we just copy and drag that, and that should also give it away as to where we want to be getting in. Okay, so we get our bearish pattern, so we can either get in here or we can get in when it breaks support. So once we've now confirmed the price action, we've confirmed the pattern, and now we look at what the smart money was doing. Well, if we go over to have a look at the smart money, we actually go here to just bring it up for you. You can go to Inside a Cow. There's IBM. And if you have a look, IBM had a slew of selling. I mean, there's about, I mean, I've gone down almost 3 pages worth of data now. Yeah, I mean, we're talking about millions upon millions upon millions, not just from one person, but from the entire, almost the entire board, senior vice president, directors, general counsel, VP controllers. So when we see broad-based chairman of the board, CEO, when you see broad-based selling across the board ahead of an earnings announcement, well, that doesn't bode too well for expecting any massive profits, does it? Because while someone might not sell, with someone selling, it doesn't necessarily mean things are terrible, but it usually would mean, if everyone's selling, that it doesn't mean things are great, because no one in their right mind would sell their own stock if they knew a 20% gap up was coming. Of course, you can then look at the institutions, and we saw that BlackRock was bailing out earlier in the year. So there's our first check on the insiders, the smart money. But then we go down to this indicator, and what we see is that we had broken down sharply right ahead of that earnings announcement. So if you do a comparison here, look, when the price was the same price before, about a month and a half prior, at $183, Smart Money Indicator was saying we've got negative 6% of money flow. Versus over here at the same price, almost negative 20. And this gave us an opportunity to buy puts and pick up close to 800% of potential profit there in just a couple of days. And that's by combining the pattern and the smart money. And that was it. If you go and have a look at Twitter, this was the same thing. A head and shoulder pattern. We can measure that and then duplicate that down, and that called for a drop from 45 down to 40. And so what did I buy? $47.50 puts, I think it was, when it was up here at the top of the right shoulder, and those were up 300%. But again, look at what we're doing. We've got a head and shoulder. We have a declining neckline. And we can see that as the price was basically stable, was going sideways, the money flow dropped right away. Substantial divergence here from the money flow indicator. So this is where you start to get some, and of course, if you look at Twitter's insider selling, it was almost worse than IBM. Okay, so we can start to see here where the smart money is selling off into the rally that everyone else is buying. If we look at the S&P 500, this was also one of the key warning signs here. In the S&P 500, I mentioned that at the beginning tonight, today that more recently we called the drop in the market on the S&P right on the money basically, and have a look how there's a couple of key drops here. There was this drop back here early in the year. This was a head and shoulders pattern. Left shoulder, two shoulders on the left, two shoulders on the right. And you can see the money flow diverging, price going up, money flow going down. This was an easy pick to short the S&P 500 and stocks within it. Here on Tuesday, July 29th, we picked that. And then once more, you can see again this top here on the right-hand side, same thing. Look at how the price of the market is making higher highs and higher lows. But the smart money was selling off. Again, this drop in the market in September, October, easily predictable. And of course, drops in the market are often far more rapid than the rallies back up. And so there's a lot of money to be made on the short side when you can predict this. Are there any stocks that people would like me to have a look at here? Please feel free to throw them up into the chat window. GILD, Netflix, okay. Gilead, this is one we actually picked it's last week, I believe. Yeah, so Gilead, we've actually picked this as a short last week. It's been a very, 2 weeks ago. It's been a very strong stock historically, but it had broken it's broken its trend line. And as we can see, as it had rallied up and made higher highs, we've actually, the smart money has been selling into that. And so this was something we actually picked as a short back at about it was $106 or $107 for the puts on this. And that's been dropping away. If we look at where strong support would be, however, you can see we have that smart money support at this $90, $92. Got sharp, fresh, aggressive rally right there. So would I be shorting this beyond $97, $98? No. It's already well in the money on the put side, and and I wouldn't want to challenge that strong smart money support. Netflix. 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 Netflix was also one of our. This one was also one of our picks for earnings. Did 1,200% on the puts on that one, and we've actually got the live video which we published when we made that pick as to how we found it and so forth. But this had an ascending, rising wedge formation. There's a rising wedge formation that is bearish. So we had a bearish pattern. The insiders were selling, institutions were selling. Its P to E ratio was through the roof. And again, look at the divergence. This was one of the best picks that we had during the earnings season, if not the best. And again, I would argue that that was highly predictable. We did an options during earnings workshop that night on Tuesday, October 14th, and this was the one we picked in it. And you can see how that did. Right now, we're once again coming down under a momentum-based system, it appears, to support. And again, we're coming down to that 340 support level. Smart money's still selling off, but I'd be cautious of that price. Yeah, so we're going to possibly coming into it appears that we've got if we do a parallel line from the top and the bottom, we've got a possible channel bottom that we're coming into on a larger time frame. So I would be worried about that. I think that we're coming into support. So and so I don't have to think about that. I would be buying support, and if it broke through, there could be a possible shorting opportunity there. Okay, let's have a look. SGI, gold. Okay. So there should be SGI here on the screen. So SGI, we can see there isn't really a clear signal from the smart money standpoint. If we look at our this is where proper trend line drawing comes into place, by the way. Most people always do this. They go right to left. They get their line out and just draw it arbitrarily off to the left-hand side. That is not a correct trend line. That is how you will almost always do yourself damage. Because if you draw your trend lines incorrectly, guess what? You don't know what the pattern is. So if you drew your trend lines in wrong, you're not going to be left with a shape that will tell you how to trade the stock. So just an example on this one, we always go left to right. So left to right dictates this. There we go. So currently, what that tells us is that we are at support, but it's fairly weak. It's not this. It hasn't really quite gone anywhere yet. So it's still it still has some work to do. Gold. Gold is interesting because gold, for those of you who don't know, gold follows an indicator which is only useful on gold, which is the 161-day exponential moving average. And if you look back over 10 years, you'll see that it's incredibly accurate. Every major rally that gold, I think 13 times out of 18 is what I worked it out to be, it has been, it has provided support, and the times where it's broken it have often been fairly catastrophic drops. So anyone considering gold, we always want to be looking at what the 161-day moving average, exponential moving average. So we are coming off a break of a descending triangle formation, and is starting to rally. And I believe we'll probably have a test of that resistance line, possibly a run all the way up to the 161-day. And so we've actually, one of our picks from last week, early last week, was NUGT, which was actually up 12% today. We picked it at $14.50 to $15. It's closed at $16.69 today. It's NUGT is a triple bull on the gold miners. But that could easily get up to around that $17, $18, which would be about a 30% return. I can see some questions regarding the money flow indicator. Yes, we did design it, develop it into Think or Swim, as well as Metastock, as well as TC2000 is the packages we have developed it. So we actually, it is not commonly available in any other program. It is something that we custom designed in those systems, as well as a couple of other things that we also employed, especially into the systems like Metastock and Think or Swim. Okay, so I'll come back to, if we have, we're getting short on our time here, so we can come back to any other questions here in a moment. But just to kind of to talk about how this kind of sums up is, it's the whole idea of trading is understanding probability. I was in Las Vegas for the last 5 days at the International Traders Convention and International Trading Money Show, and it was interesting watching people playing on the blackjack tables and so forth. People that would have this horrible hand and play it anyway because they want to be in the game. That's not how you make money. Making money long term is like how the poker experts make money as a living. To be making huge money as a living gambling seems strange, but there is a way to do it. Just as in the market, there's a way to consistently have high probability trades. And it's just like a poker player. It comes back to understanding what the high probability hand is. So when you look at a chart, as I said earlier, your question should not be what should you do with it. The question should be, should you even do anything with it? Is it a high probability hand? There are about 7 or 8 things, about 8 things that all have to be there for me to buy a stock. That's what makes it high probability. And that includes the pattern, it includes the money flow, it includes fundamental filters, it includes technical indicators in terms of volume patterns. Everything has to be there. So the probability and to that point, when I scan the market each night, there's only, out of 8,000 stocks, there's usually only about 3 or 4 that I'll find that even come close to having all of those things, out of 8,000. And those things are all crucial to being high probability trades. So if you're the kind of person that only trades Apple or only trades IBM or a collection of a handful of stocks that are family names, the probability of one of those stocks having all of those factors is slim to none. There's only maybe a few high probability trades per stock that happen every year. So maybe 5, 6 times that IBM will have that perfect shorting opportunity. That, like Netflix had that perfect shorting opportunity. That only comes around once every now and then. But every day there will be at least a stock or two that will be set up like that. And so the key is being able to find it. That is the most important thing. Because keeping consistency in what hand you play is what will make your money long term. Imagine being able to play poker and only ever playing when you have 2 aces. Wouldn't that be good? The beauty about the stock market is you can do that. In poker you can't because you have to pay blinds, or you'd have to wait a very, very long time until you finally got those 2 aces every time. So in poker it's not realistic. In the stock market it is. In the stock market you get to look at your hand without putting any money down. You get to look at that chart and say, is this an aces hand? And if so, what's the probability that I'll win? And how much does this hand suggest that I will win? All of these things are what market technicians have spent, well, what I've spent the last 12 years of my career working out, is what are the highest probability patterns? If I trade 100 of these, how much will I make? How much will I lose? What percentage of the time will I win? What percentage of the time will I lose? What are the confirmation factors? And it's to get the scans that we use to the point that they're at. It has taken 12 years, and but that allows us then to ensure that every single trade we do is exactly the same. It ensures that we're efficient. So basically, idea of making money that's efficient to your time. And in trading, that's what scans do. You can sit in front of the computer all day long if you want, studying indicators and live data and so forth, and maybe you'll make a couple of % more, but I would argue for the extra time, it's not worth it. I don't trade because I want a job. I trade so that I can take off to a conference for 5 days and not have to worry about my portfolio because all the cells are already set and they're already managing my money without me needing to be there. And that's what scanning is all about. It's about making your money work for you by allowing technology to do what technology does best, which is make your life easier. We are doing a workshop on this. I'll just give you the details on that. I mean, obviously, as you've probably seen, October through December are huge months. January and through May are also perfect as well. And this is where we make most of our money. And so this is a workshop that we do once a year, well, twice a year. Actually, we do it here towards the end of the year and then once again in January. And it's all about scanning. So it's on Thursday, December 4th. And basically what I'll be doing is you'll be, you get the smart money indicator, or indicators, I should say. And we also then give you the scanning setups that we actually use ourselves every single day that locates those high probability trades. So we'll be going through the scans, teaching you those scans, teaching you how to properly draw on the support and resistance to locate the patterns. We'll be talking about what those high probability patterns are, and of course how to scan for those as well. We'll also be going through learning how to identify when the pattern stops working and how to anticipate changes in the market instead of reacting to them. The difference, we'll be teaching you how to, on top of learning our scans, we'll also be teaching you how to create your own scans. So learning the difference between triggers and conditions when building a scan, and we'll be showing you all of this on free available online tools. And finishing up with then giving you a checklist that you can apply to any trade that will keep you safe. So Again, it's only $47. I think for the 2 hours, if you don't find immense value, you just let me know. We will refund that to you. I'm not a believer in giving people something that's not going to make you money. You don't need to buy a software program at the end of it, or buy another package from us to make it work. At the end of the workshop, you'll be able to walk away and start using this stuff immediately. And we've had some amazing responses from this. Again, our options during earnings plays were incredibly popular. And oops, there we go. So just go to that link. It's acornwealthcorp.com/light, and it should be I think we're at the end of our time now. But actually, it should be an excellent workshop. It's a wonderful one to teach because it's full of stuff that you can just basically take away and begin using immediately. I'll just make sure that there's no other questions. So is the indicator ready for TradeStation? TradeStation, we've been told that TradeStation were meant to be releasing a brand new upgrade that would need everything to be recoded in it, and so we've been waiting for that upgrade to come out. It hasn't, so that's what we've been waiting on. The indicator is available. All of the indicators and scans we use are coded in Metastock. Incredible charts, TC2000 and Thinkorswim currently. And also the scans we use can also be, we also show you how to set them up in free available third-party programs, such as FinViz as well. So these are, this will allow anyone to be able to use the scans. Is there a limit to enrollment? Yes. The limit to enrollment, we do limit it to 100 people. And that's because that is the training room that we use. It does have a capacity of 100. And one thing though is if you do miss the live workshop, we allow you to come back and retake that workshop as many times as you want when we rerun it. One of the things that we do with all of our courses is allows you to go in there and sign up for the future events at no additional cost. Okay, I think that covers it. If you do have any other questions, you can email us at coaching@acornwealthcorp.com. I'll just pop that in the chat window. And of course, a big thank you to Jano and Rolly over at Trading Pub for having us on today. And I look forward to seeing many of you in the workshop.